Welcome to Convince Me in 15 Minutes. This podcast will introduce you to concepts, theories, and philosophies in the world of finance, investing, and wealth management explained in 15 minutes. Your guides are Keith Thompson and Luke Tawiz.
Hi, everyone. This is Tavi Costa from Crescat Capital. I'm a macro strategist and partner of the funds. And today I'm here to convince you for why I believe we're entering the very early stages of an inflationary era. So let's get started with some charts, and hopefully that will make the case of my views. I think that at the very beginning, it's important to talk about that we're facing something we've never faced before. It's that what I call the trifecta of macro imbalances is a debt problem of the 1940s when we had the World War II. It is the valuation problem, similar to what we saw in the tech bubble and prior to 1929, where markets, and especially equity markets, got highly frothy when it comes to valuations. And third, inflation. Inflation is a problem that historically we haven't seen this since we've seen in the 1970s. And so that combination of those three imbalances is something we've seen independently in prior decades, but never all at once. This is the main reason why I believe inflation will prevail in this environment. And it's because I think policymakers are going to be facing some real political constraints given those imbalances, and therefore will be forced to allow inflation to continue to run higher. So let's get started with the next chart. Where I showed the three waves of inflation. And I believe this should be in front of every policymaker when they are making their own decisions and opinions, forming their own views regarding where we are in this inflationary era. First, I believe that inflation develops through waves. And as you can see here, it's going back to the 1966 all the way to 1984. And it's showing that during that inflationary period, we've had inflation developing through three periods. The first wave of inflation from 1967 all the way to the 70s or so. And then we saw the second wave that got progressively higher. And as you can see, we went and peaked at about 12% or so in 1974, which caused a very steep recession during that period, a stagflationary one. And then the third wave was even worse. Do I think that that's the case today? Yes. And that's why I pointed an arrow saying that I believe that we're just seeing the deceleration of the first inflationary wave, and therefore we're likely in the process of bottoming out the consumer goods, services, and goods growth of prices. But there's a big debate in the macro environment that likes to suggest that instead of the 1970s, we're facing the 1940s. So let's go to the next chart because it's important. The 1930s and 1940s also saw waves of inflation. We did see, despite the fact that the government was able to not allow interest rates to rise, and what we saw in the difference between the 70s and the 40s was that the 1940s did see a very large amount of leverage. We had government debt to GDP at 130, 140% levels, and therefore, the government was forced to impose financial repression at those periods. And at that time, we did see, although we saw financial repression, we did see inflation developing through waves. And so this is another importance for why I believe this is a roadmap for today's environment. And we can debate if we're going to see financial repression or not. And I do believe we will, given the political constraints of particularly valuation of financial assets. We either going to face a Great Depression or an inflationary era. And I think that the less painful one or the less painful alternative certainly is inflation, and therefore the reason why I think we're going to go through one of those. Let's go to the next chart and maybe talk a little bit about the main reasons for what I call the pillars of inflation. By the way, in 2021, I put a letter out, the research letter out that I call the three pillars of inflation. I think we're probably have been expanded in this idea, and this thesis now I think has multiple pillars of inflation, not only three, and I will discuss a few of those. One of them has to do with this way where the US economy and other developed economies, in my view, are addicted to very high levels of government spending. I think we haven't seen a period where the economy has been heavily relying on fiscal stimulus as much as we're seeing. And uh, not too long ago, Wall Street Journal had an article talking about how the fiscal spending today is not very stimulative because the majority of that is actually interest payments. And to me, that was rubbish research because you can see this in this chart. Fiscal spending, excluding interest payments, and I'm not considering tax revenues, obviously, because that's a separate discussion, in which has been rolling over, by the way. But just looking at fiscal spending alone, excluding interest payments, you can see clearly we're somewhere close to over 20, close to 25% of GDP. Those are levels that you tend to see after a very steep recessionary period. We haven't seen one yet, and we're already seeing government spending at levels that are, way above what we saw in the 70s, for instance. And so this is a very problematic. And in my view, we're in the early stages of a lot of parts of the fiscal agenda. The fiscal agenda has never been so large. You can talk about social programs, defense spending, manufacturing spending, reshoring, green revolution. All those things are at the very early stages of their own projects. And so I think this is going to become a really important issue that will, in some ways, become this feedback loop towards inflation over time. Let's go to the next chart. And as you can see in this next chart, the second pillar of inflation is the chronic underinvestments in natural resource industries that we're seeing. This is creating why commodities have been so constrained over the last 2 to 3 years. A lot of people have been linking this to the pandemic problems, but although the pandemic, I would say, trigger a lot of those issues and trigger a lot of those large historical imbalances. This has been a secular movement, as you can see in this chart, where we're calculating the aggregate capital spending of commodity businesses that has been, and I adjust this for GDP. And why do I do that? Is because $10 million spent on the ground today is certainly not the same as $10 million spent in 2008. We've got, the cost of the effectiveness of that cost is completely different due to inflation. The economy is much larger than it used to be back in '08. And so the adjustment is absolutely critical. And as you adjust for that, you can see that we are at one of the lowest levels in history when it comes to CapEx, the CapEx cycle. And if there's one thing that, in my view, the commodity cycle is predicated on, it is certainly the cyclicality of the capital spending among natural resource industries. And today, it makes me believe that we're very similar to levels like we saw in the early 2000s when the commodity markets had a bull market that was very important bull market that also, in my view, today will be another source of an inflationary force that will likely be very persistent. Let's go to the next chart. And so if you see here, this is a chart from Bridgewater's. I think it's the only chart that is not from Crescat. But as you can see here, it's showing how inequality is also a problem. And we didn't see that in the 1970s, by the way. It's basically looking at the bottom 90% of the population wealth and seeing how the 0.1% of the population is actually almost larger than the bottom 90%, which is, it's mind-boggling to think about it. But the last time we've seen this was in the 1930s. And that was a time, what they call in this chart, the era of populist. I'm going to take a little bit of a different take on this. While I do believe that this era of populism is critical for a lot of reasons, one of them being deglobalization, which we will touch in a minute, I would say that one of the things that is very important about this chart is the fact that if you think about how emerging markets work, and I'm from Brazil, and what is interesting about the fiscal agenda in those countries, given the fact that they have been living through not only inflationary periods for long times, but also inequality issues for a long time, what you tend to see is that the government is forced to intervene with larger and larger social programs. Does that sound familiar? We're seeing exactly that here today, through student loans, types of policies, even the pressure from higher cost of living, causing the government having to step in and create some sort of social benefit that helps, especially the bottom 50, the bottom 30% of the population, to feel more welcome in the economy. So this is a societal issue that I think will continue to pressure inflationary forces much higher. So let's go to the next chart. And as you can see, Google trends for strikes. So we're seeing labor strikes everywhere. Well, why is, a lot of people are seeing those strikes as isolated events. They're not isolated events. They're, in fact, one tends to, it's almost like a domino effect of those things. And when you think about this, it creates what I call wage price spiral. And therefore, the elevated cost of living gives the worker that is painfully living in this environment ends up demanding higher wages. And so this is indeed a very inflationary force where tends to be highly secular over time. So the last time we've seen this is literally in the 70s. And a lot of people are thinking about this a little different. They're saying, well, I don't think we have room for those workers to demand higher wages. No, we do. If you looked at the labor cost relative to profits today in America, in corporations, profits are way too high relative to how much they spend on labor cost. And I believe strongly we're going to go back to the average that we've seen in the past. And if that's the case, there is a lot of room for those businesses to pay higher wages to those workers. As you can see here, this is another important chart, which is regarding deglobalization. I told you I was going to touch on that. Well, here it is. Funny enough, we've seen all signs of it. We have two wars breaking out currently. One started with Russia and Ukraine, and now we have another one is Israel and Hamas, and potentially others may not only expand, but also potentially creating new wars all over the world. We've seen tensions between U.S. and China rising over time. You can maybe argue that that deglobalization trends really began to intensify in a significant way when Trump started to in 2016 in his own election period, when he was starting to really talk about those issues between U.S. and China, which to me was really the first time someone really brought that up in a big way, and became a topic. And now it became bipartisan topic. Look at how even the Biden administration is behaving towards China, which is very different than 4 to 5 years ago. You may make a point that Trump is even more consistent when it comes to the way he deals with China. But if you think about how Democrats have changed the way they behave towards China, policies overall has really shifted from 4 to 5 years ago. So deglobalization has a lot of important aspects, and one of them is defense spending. And defense spending creates government spending that then creates an inflationary force in the economy. I've got all the pillars of inflation here today. I believe strongly that this is going to be very impactful in many ways in the global economy. Deglobalization trends, inequality issues, wage prices spiral, chronic underinvestments in commodities, reckless fiscal spending, all those things are going to have an impact. And I'll leave you with one thought. If we're going to see reshoring, green revolution, the manufacturing revamp that I'm talking about, all those policies happening towards most of those. And another aspect that I didn't even talk about, affordability for housing. There's a reason why Warren Buffett owns home builders today. It's because we're going to see probably a large increase of building in residential assets overall, and also commercial at some point. But that will create demand for materials. How in the world we go from all those policies being successful without creating a relevance for metals and mining industries that today are almost like a margin error relative to the overall economy, not become a lot more important over time. And think about the dynamic of that capital flowing towards those industries and how that will create potentially great opportunities for investing in the next 5 to 10 years. I think that's one of the most attractive ways of expressing this view of an inflationary era. And there's some other things too, but this is probably one of the most important ones. Another thing just to think about is how the cost of capital of the global economy will be impacted by this. How governments having to spend more and more, given the fact that they are addicted to this fiscal spending levels being near record levels. How will governments have to structure their debt issues and how much issuance of debt, and how would that drive cost of capital again, given the fact that interest rates may have to rise given those issues? Those are all very important questions in a world that is very different than the prior 10 years, 20 years that we've lived through, and that I think a lot of people are ignoring. So with that, I'm going to pause on my presentation. I hope this was helpful for other folks.
So when you look at these three waves of inflation that it's apparently history repeating itself again, what was it that ultimately did tame inflation? Was it the economy breaking? So what led to kind of getting inflation in check?
Well, you're referring to those decelerations or the very end of the inflation period?
That after that third wave, after that final
Understood.
deceleration, what led to that final deceleration?
Well, I think a lot of things. Number one, that was an era, that was a period that, as you see commodity prices increasing, it basically creates the necessity for those producers to spend more money on looking for supply. So the market fixes itself over time, given the fact that there is high demand. It will necessarily improve supply over time. So that was one of the reasons. In fact, during that period, we faced one of the worst times when it comes to finding discoveries of resources in history. And one of the main reasons for that was also access for capital because interest rates were rising. Number two, I would say that we've had the peak of labor cost relative to profits of corporations. So that was a time when corporations said, no, I can't squeeze any more of this. I can't pay you more. And that was the end of it. That was the end of how we treated workers, and workers had to deal with lower wages and salaries relative to profits for another 30 years. And so we go through those periods. It's absolutely normal.
It's fascinating to me. We had an interview with another asset manager, and he has a 30-year track record. He's seen inflation. He's seen ups and downs in the market. There are a lot of asset managers who've never seen inflation, who have never seen the kind of the hyper valuations that we're seeing in the markets right now. But we have policymakers who are in their 80s. They have seen it. So why is there this, I feel like there's this disconnect between the understanding of the kind of the harbingers of inflation here and the behavior kind of to help take care of inflation?
Well, one, I think not everyone is a student of history. Number two, it's very normal in terms of market behavior to see people forget about things. That is why we have cyclicality of markets becoming frothy and less frothy. And we think this is a revolutionary period, and therefore we should be paying more for a certain business. But then we forget about how valuations are so high relative to history. So I think this behavior of finance approach is playing out again. And the fact that, think about how cyclical inflationary problems have been over the past. And every time we saw this cyclical rise in inflation, essentially happened right before a recession, and then a recession is caused, a deflationary type of recession unfolds, and then causes inflation to go back to below or close to 0% and so forth. And so we've seen this happen way too many times, and so it makes us become more complacent. I think this is normal. There are other issues too. I mean, I was showing that chart of even commodity producers and so forth. this is a very unique environment we're living in into that industry itself. When was the last time we've seen ESG policies, for instance, ESG policies playing such a big role into forcing energy companies or even metals and mining industries to not be able to really explore and develop and produce natural resources, given those policies forcing them to avoid the development of those projects. And that those are very important questions that we haven't really faced in other periods of history. And so there is some uniqueness to today's environment. But I agree with you. I think that not only policymakers, but the majority of asset managers are really dismissing the case for inflation being structural. And one of the reasons for that is because a lot of them have not lived through those periods. Now, coming from Brazil, to me, this is unmistakably an inflationary era, and it's I know it's a debate still, but I think we're going to see more of that teeth of the inflationary problem showing very soon one more time, and it's so clear to me. I mean, we have two wars breaking. When was the last time we've had two wars breaking out the way we have today? When was the last time we saw the government spending 25% of its GDP? With all those issues I said, like defense spending being at all-time lows. When was the last time we've had, along with those things, commodity producers' capex being so low like we're seeing today? Or just think about from a financial market perspective, 60-40 portfolios, a traditional way to deploy capital in the markets. They completely ignore hard assets, right? What if we see those investment strategies starting to deploy capital into hard assets? Well, that creates a reflexivity environment where commodity prices could start going higher just for the demand for the allocation period becoming higher for hard assets. What if we see that? That those are all questions that are, in my view, very relevant to think about, not only from how to express a view here, but also how we can potentially see the upward pressure on a lot of things that can potentially create an inflationary era.
I think you've made the case of why inflation's here to stay, and I totally agree with you. If you're an investor, inflation isn't bad for all things, right? If you have a ton of debt like the U.S. government, inflation, doubling the prices of everything means your debt is essentially not as bad as it was, before that inflation was here. So what areas tend to benefit from inflation? What areas tend to get hurt by inflation?
Well, let's start with the equity market. The equity market would be an important one. I don't have this chart here, but if you think about the 1910s, 1940s, and 1970s, were the most important inflationary eras we've had in the last 100 plus years. And what happened during those periods? Take the Robert Shiller data from Yale University and look at the very beginning of those decades and the very end of them. Look at where CAPE ratio was and where CAPE ratio ended. I'll tell you what happened. Average decline of 47% in those CAPE ratios. What does that mean? Well, that means there's a compression of multiples that happens during inflationary eras. That can be caused by many things. It can be caused by earnings improving, right? If earnings improve because we are in an inflationary era and companies are able to charge more for their goods and services and they make more money in the nominal basis, well, that's one way. Well, the second way that it could happen is that prices go lower, therefore causing that multiple compression. Or you can just see prices going sideways with nominal earnings improving over time. The problem here is that, number one, different than those three other decades, what we're seeing today is that the CAPE ratio is starting at way higher levels than we saw back in those days. Those days we saw mid-teens for CAPE ratio, which is cyclically adjusted PE ratio, by the way, stands for. Today we're about 30. So we're twice the multiple that we saw at the beginning of those inflationary eras, which to me makes the case that maybe prices are the part that is really inflated. You can also say earnings are already inflated. In fact, this was the 2010s, which was the prior decade, was the best, the most robust period of corporate earnings in real terms that we've seen in history, period, but dwarfs any other decade that we've seen. By the way, we've never seen 2 decades in a row of that type of corporate growth earnings. And so I don't think I'm in a camp that I think we're going to see a squeeze of margins caused by many things, by cost of things going up, by material costs going up, by deglobalization trends, by wage price spiral, really pressuring those companies to pay more to workers. All those things, in my view, are going to have a large impact, and by traditional investment strategies shifting away from 60% of equities to maybe more hard assets. That creates then an opportunity in commodities. If you think about it, we had 4 commodity bull markets since the in the last 100 plus years. One happened in the 1910s, one in the 1940s, one in the 1970s. All those 3 were inflationary eras. Okay, but I'm missing one. Which one is that? Early 2000s. Early 2000s was when China was entering the WTO, as I explained briefly before. Well, we're seeing G7 economies trying to reshore and revamp their manufacturing plants. We're also seeing the beginning, likely, of an inflationary era. So we have those 2 things, those 2 factors that help those periods of commodities doing very well happening today. The third thing that we didn't see in those times that we're seeing today is this long, but really long period of under allocating capital towards commodities. Can we see a shift towards that? I think so. And so I believe that the commodities space are going to do very well. And it's why you can branch that out and think about emerging markets that have resource-rich economies like Brazil that can do very well in that environment. Well, there's a reason why, if you looked at a business in Brazil, it today trades at 3, 4, 5 times earnings relative to a FAANG stock that trades today at 100 plus times earnings. Why would you take that risk, knowing that there is a compression of multiples that happens in inflationary periods that happen in all 3? And why is it not going to happen today again? So, no, I think, from a risk-adjusted basis, this is one of the periods, to me, looks very clear that one should be deploying more capital, or at least paying attention to commodity-related businesses that may do very well here.
I'm kind of obsessed with this concept of how does this resolve? I think probably more so now than in prior generations. You have a lot of, we'll call it less financially educated people, have significant exposure to the markets through their 401ks, et cetera. And, we had somebody on recently who dealt with investor behavior. We've all seen the studies that if your portfolio is down X percent, you're less inclined to be spending money. I think we've been obsessed with kind of getting the soft landing. Is there any way out of this other than kind of an event-driven conclusion?
Well, there's the potential for just, rather than one event that causes things to be readjusted in terms of valuations going from, like a 40+% compression in multiples happen in a month or 2. It could be the case that we may see a very consistent downward trend for the next 10 years or so. And then that could be very possible as well, where the adjustment of all this happens in a very long time. I mean, just looking at again, behavior of finance and thinking how younger folks had been so used to, in fact, mocking hedge funds and other folks that have been in the business for a long time, of how easy it is to find returns in the markets. And it's not usually easy. It's been easy recently. And no doubt that a lot of people that don't spend a lot of time understanding markets have been able to outperform folks that understand markets. But, I think this is setting the stage for a lot of unique abilities that have not been useful in the last 20 years, likely to become very useful. I'll give you a few of them. Value investing, understanding companies, the old school Warren Buffett style of really understanding what a business has in terms of a moat to perform well in any environment and so forth. We are probably going to go back to those types of abilities. So studying those folks that have done well in the 90s and in other periods like the 70s is, I think, are going to be critical. Understanding commodity industries. There's a whole segment of ability there. Just thinking about one thing that comes to mind is the fact that we've seen also a secular decline in geoscience enrollment. So that is in line with the fact that we're not seeing capital coming into commodity companies, right? So the fact that we're not seeing folks or companies make a lot of money in those industries also creates less interest from students to learn about those industries. So if I had a kid today, I would tell him to, instead of studying what's been hot recently, which is AI and other things like programming, other things that used to be even more of interest in the society, I would actually caution them and to think about other things that have been out of interest, like commodities would be one of them. Becoming a geologist might be a very important ability for the following 10 years, 20 years or so. What are other things that could potentially be the case? Understanding emerging markets. Those are very unique economies. And if you think about Brazil and the way the leadership of the market works is completely different than the US. And so understanding those markets, folks that have a very good way of approach of investing in those places are likely to do very well in this next decade. So there are pockets of abilities that I think are going to be very interesting for all this. Manufacturing, folks that understand industrial properties and other things are probably going to do well. Affordability for housing, how do you fix that? Well, home builders, who it's going to get involved in building homes and so forth. That's another ability. Although I think a lot of people think of this presentation or my opinions as doom and gloom, it is far from that. I think there's great ways to make money here and great ways to sort of defend yourself, but also to do very well in this environment, because a lot of things have been very dislocated, as usual. This always happens. And I think things that have been out of favor are going to become in favor again. And we're starting to see some of that. I mean, think about just the energy space today relative to 5 years ago. And I think we're going to see more of that in other aspects of the commodity space, of emerging markets, of FX. Now, I think FX volatility is going to be much higher. Understanding macro is going to be in higher demand. Understanding geopolitical issues is going to be in higher demand. We've had a lesson of that in the last 1 or 2 years, didn't we? And so all those things are going to be changing moving forward.
Hey, Tavi, I think investors love acronyms. You just mentioned Brazil, and I remember when the BRIC, Brazil, Russia, India, China was extremely popular, and then all of a sudden valuations went way up, and now you have, then you had FAANG, Facebook, Amazon, Apple, Netflix, Google. Well, now there's a theme called FAANG 2.0. I don't know if you've heard of it, but it's fuel, it's agriculture, it's aerospace and defense, it's nuclear with uranium stocks, and the last is G for gold and precious metals and other metals. And fuel, and which is the first F, and then G for gold and metals is basically this chart right here, which is the commodity producers. I mean, these are trading at historical lows and provide extremely good free cash flow. Any parting thoughts in regards to this area of the market?
So I'm not a billionaire myself, but I love studying billionaires because I think that's a successful way of financially doing well with your endeavors in that part of your life. And what I understand about that is majority of them are very consistent. They tend to pick a macro trend that did very well for, secularly speaking, for 10, 20 years. And the other aspect of them, and not all of them fall into that category, but majority of them do, is finding a distress opportunity. I think the metals and mining industry is probably the most distressed opportunity I've ever seen. You can see gold, for instance, trading at historically high levels, although I think it's cheap relative to all the imbalances we have. just normally looking at the gold chart, going back to the 70s or so, you can see that gold is trading at near all-time highs. Now, a property that has gold in the ground is at historically low valuations. You have to ask that question, why? There's reasons for that. This industry has been bleeding capital for many years, many decades, has mismanaged assets for many decades. And we've had a technology boom that caused most of the focus to be in those things relative to necessities to run the global economy. And so I could go on and on other reasons for why we're seeing that. But have we seen enough of that? Is that already priced in markets that maybe it's time to be taking a contrarian approach and be deploying more and more capital into those things? I think so. I think this is the time. Like I said, I don't think we're going to go through all those fiscal parts of the agenda of green revolution, reshoring, revamping manufacturing, defense spending, and other things without creating metals and mining becoming a much more relevant segment of the overall economy over time. And so I have been very bullish in that part of the market, and I think that's one of the things that will do very well. Very interesting what you said about the FAANG 2.0. I agree 100% with that. And I think, I think there's natural resources is just one of the ways to be thinking about deploying capital here. And but obviously doing your homework, because there's a lot of unfortunately, the funny thing that is that an asset in this space that is a poor quality one relative to a high quality one are basically priced at the same level, which allows you to buy something for really cheap, and hopefully avoid the other one. But it's incredible. I mean, institutions love a distress opportunity, right? Well, here we are. We have a distress opportunity, and everyone is neglecting it. And so, I think this is a classic market behavior, and I'm ready to get busy accumulating assets in the space. It's been what I've been doing. So.